I now hand the conference over to Mr. Abhishek Singhal. Thank you, and over to you, sir.
Very good evening, and thank you for joining us today for Strides earnings call for the first quarter ended financial year 2021. Today we have with us Arun, founder and non-executive chairman, Dr. Anant, CEO and managing director, and Badri, executive director and CFO, to share the highlights of the business and financials for the quarter. I hope you have gone through our results release and the quarterly investor presentation, which have been uploaded on our website as well as the stock exchange. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and must be viewed in relation to the risks pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Arun to make the opening comments.
Thank you, Abhishek. Good evening to everybody, and thanks for joining in a little late than our standard call time. We do appreciate your availability at this hour. Before I start, I do hope all of you are being safe and healthy, not only you, but also your loved ones. We all live in very unique times, and in these circumstances, we continue to manage running a business which is a very important part of these challenging times. And I'm glad that with the new leadership that we have at Strides, we have delivered a very stellar quarter. I'm extremely pleased with Anant and Badri and the rest of the team for having delivered an outstanding quarter, especially given a comeback quarter from the fact that we left significant value and profits consequent to the ranitidine withdrawal. It's been a great performance, especially in tiring times given COVID. And I must say that we had a relatively easy Q1 in terms of COVID cases, especially in Bangalore, where now Karnataka has become a hotspot. Unfortunately, as days go by and in this quarter, we see those challenges to be a lot more magnified, and we're working our way through all the challenges that go through that most companies face. But we continue to be confident that we will deliver. We'll continue to deliver from here on. And I will now, without taking away any of the thunder from the management team, request Anant and then Badri to address the meet today. I will then come back on specifics related to our Stellas business and also the current status of our injectables investments. And I'll take questions around those businesses while I let my colleagues address all other questions related to the rest of the business. Thank you, and over to Anant.
Thank you, Arun, and hello everyone. I hope all of you and your loved ones continue to remain safe and well in these challenging times. Q1 has truly been a bounce-back quarter for Strides, post the withdrawal of ranitidine in the US on the last day of March 2020. We've reported strong performance across all our businesses. This performance comes amidst the significant disruptions and ambiguity that exists in the business environment due to COVID-19. I want to specifically call out our global workforce, and we are proud of their exemplary efforts to keep the operations running during this crisis. We continue to pursue a people-first approach, and the well-being of our employees remains our top priority. In line with our commitments to serve the patients, we have demonstrated resilience and agility, and our manufacturing and supply chain remains steady without major disruptions. Our regulated markets grew by 22% over the previous quarter, and our emerging markets have returned to growth after several quarters. We have delivered a 920 basis points quarter-on-quarter EBITDA margin expansion with superior cash flows through a healthy operating leverage. This is a significant uplift from the 68 crores that we reported in Q4 post ranitidine withdrawal to rupees 158 crores in this quarter. Our overall revenues grew sequentially by 26% to achieve about 785 crores in the quarter. We are happy to report sustained gross margins, about 60% for the last 3 quarters, which in this quarter was 61.5%. Let me now share some specific updates about our markets. Our US business had a strong comeback, growing quarter on quarter by 28% to report about 374 crores or $50 million. This rebound back from a $48 million in Q4 has been achieved within a quarter without ranitidine on the back of a strong product portfolio. During the quarter, we received 3 ANDA approvals and filed 2 ANDAs. In spite of us leaving about 120 crores on the table due to the ranitidine withdrawal, new products that were launched in Q4 gained momentum while we continued to maintain market share without price erosion. Having said that, we do see some headwinds due to COVID led by lower prescription rates, reduction in elective surgeries, and lower footfall in the pharmacy, as well as lower reordering by our customers. Despite this, our base business continues to maintain a steady market share. As regards other regulated markets, business continues to scale and grew 53% year-on-year and 15% sequentially, reporting its highest quarterly revenues of $35 million. Performance was driven by key front-end markets of UK, Germany, Nordics, Netherlands, as well as our partnered Australian business. We filed 4 new products and received 2 product approvals in Q1. Our portfolio fungibility continues to drive market penetration. In our previous commentary, we had indicated that our US business will deliver 25 to 30% growth during the year. Having said that, due to the COVID-related softness on the business, as I indicated earlier, we remain optimistic that our combined regulated market will continue to scale and are confident to achieve similar aspirational growth levels. Coming to emerging markets, we are clearly seeing turnaround and green shoots in the performance. Africa business grew 73% year-on-year and quarter-on-quarter, driven by key brands and improvement in primary sales in line with our secondary sales. Although, again, there is some softness that we've seen in acute therapies due to lower prescription rates related to COVID. The institutional business was on track with a 30% growth due to higher order pickup by donor funds. During this quarter, we received a WHO PQ approval for TLD, the ARV product under the new treatment regimen. This product is currently under country-specific registrations, and we look forward to launching this product during H2 of FY21. Coming to some update on our Puducherry facility reclassification. We would also like to provide you with the current status on our Puducherry facility. We have completed and submitted all corrective and preventive actions which have been verified by external third-party remediation agency. We await the reinspection of the facility by US FDA, which is delayed by the current COVID-related travel. We continue to engage with the agency on a regular basis and shall update the outcomes as soon as it becomes available. As indicated earlier, although Q1 has been a strong comeback quarter, we believe challenges around COVID-19 will continue to bear on the industry. We are seeing an increasing spurt in the number of COVID-positive cases around us that can potentially create unforeseen challenges in manufacturing and supply chain. Any such situation in our manufacturing facilities can lead to significant disruption in operations. We also continue to see increase in operating costs, including higher logistics costs. The softness in demand will continue to be an overhang in the markets. Given these challenges, we remain cautiously optimistic on the overall business outlook for the year and will keep closely monitoring the situation. I would like to reiterate our focus on business continuity measures, which is around people first, continuity in our operations and supply chain, continued engagement with our customers, and a high focus on containment of cost and cash conservation without disrupting the business. With this, let me pass on the phone to Badri to update you on the financial aspects.
Good evening,
ladies and gentlemen. So I'd like to spend some few minutes on the financial results. We had an excellent start for the financial year 21. So we have been saying that profitability, efficiency, and growth has been our key pillars and our focus for the last few quarters. And we demonstrated a significant improvement across all the financial parameters in the first quarter of the new financial year with good confidence. Secondly, in terms of laying a sustainable foundation, we laid a strong foundation for gross margins of about 60% and EBITDA margins of about 20%. And we also expanded gross margins during the quarter, and EBITDA margins too expanded by 920 basis points post-Ranitidine. The operating leverage is quite solid, and depreciation and amortization has been very steady. The net interest cost is within a range which we have guided. And the ETR is at 4%. We believe that we will have to do some catch up during the year and expect to be in between 10 to 12%. With superior cash flow management, there has been a net debt reduction of 752 million rupees, and the net debt stands at about 10.7 billion rupees against 11.47 billion, which was reported. The most importantly, in the last call, we said that our endeavor is to maintain the debt by EBITDA ratio within the range between 2 to 2.2. We are currently at 1.7. We ended this quarter at 1.7. So we continue to focus on profitability, efficiency, and growth. And we hope to build a very sustainable performance. So with this, I will forward it to Mr. Arun to make comments on Stellas and Stellas business.
Thank you, Badri. Considering that we had a long opening commentary, and to address questions, I'll quickly give an update on the biotech and our other businesses. So the biotech business is finally getting traction. As all of us know, it's high capex, long gestation. I'm pleased to report that our first product will be filed in September in Europe. We expect to get an approval for this product in 12 months from filing. The product is already partnered with several partners in Europe and other key markets. As we announced last, Strides will front-end this market in the US and is in the process of designing its clinical protocols. It's also important to know that we have now got our insulin lodging to phase 1. We are doing our phase 1 trials this quarter in India. And we are now very excited with the fact that there has been significant changes in the regulatory pathways for insulins in the US. And consequently, we are now contemplating making the investments ourselves to go to the European and the US markets with our insulin platforms. It's obviously going to take us 2 to 3 years before we see revenues, but we are pleased with the fact that being a nascent company, we are moving on the right path as far as this business is concerned. As all of you may know, Stellas has got the Biosources division, which is our CDMO services division, which is now commercially available to customers. We have onboarded a large pharmaceutical company as our first customer for key peptides to be produced from this plant. And this quarter, we will also commission our microbial capabilities, including large-scale manufacturing of Lodgine and other insulin analogs. And the mammalian facility, unfortunately, will get delayed till April 21. This is a good 5 to 6 month delay that although the equipments are at site, we are unable to get the engineers from Germany and the US to come and install these equipments. So we expect validation and commercialization only around April. Having said that, we have starting to onboard customers for both drug substance and drug products, and we're quite excited about the pipeline that we are getting in our CDMO services. We have the ability, considering that we have invested significant capex around our Stellas business, we had the ability to quickly kind of bespoke one of our blocks into a dedicated vaccine facility for non-live vaccines. And I'm pleased to report that we now are getting ready to get into commercial production of vaccines from December 2020. These are very specific vaccines given the acute shortage of vaccine capacities globally, especially for COVID and others. We have some capabilities to produce some specific highly potential vaccines, and we are in discussions with some of the key players who are in the forefront. At this stage, they are very early discussions, but we'll keep investors informed about how we progress. I think we'll have a better guidance around where we get here in the next quarter. I just want to re-emphasize that we are only offering CDMO services and we are not into the vaccine business ourselves. So we are currently in discussions with a global company to produce some of the vaccines for the emerging markets, and we are at very early stages of discussion. Just in terms of a call out, Strides committed to invest in $40 million and to take control in the biotech business. 15 million of this has already been invested, and the balance $25 million will be invested in the next 3 quarters, along with more capital coming in from minority investors, as has been envisaged. When it comes to the injectables business, although we announced in December that we intend to get back to the injectable business, and with the events leading to ranitidine and also the COVID outbreak, we took a judicious call not to get into any big ticket investments which are high capex, long gestation, but also not do any M&A transactions till we see how the COVID situation pans out. At this stage, as was announced when the promoters were already investing in the space, we continue to stay invested. Strides retains an option to take a decision by December 2020 if it prefers to participate in the platform that is being built already as Stellas, or alternatively be in the injectable business on its own. At this time, it's a little early. We would like to see 1 or 2 quarters going before we take a final decision, and we'll keep investors updated based on our performance, cash flows, and if there are no COVID impacts. This is obviously a logical thing for Strides to do, to be in this space, given our strong outcomes that we have delivered. So with that, may I request that we are open for questions, and we'll try and make them efficient by making the questions of 1 or 2 given the time limits that we have. And like Abhishek mentioned in the opening statement, we are more than available to take any specific calls if any of you have paucity of time today to address your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. First question is from the line of Alankar Garude from Macquarie. Please go ahead.
Hi, good evening, everyone. Sir, emerging markets have done well after quite some time, but going ahead, you have talked about softness in acute therapies in branded Africa. But on the other hand, we also talked about the alignment finally happening between the primary and secondary sales, as well as the TLD launch in the second half. So overall, can you comment on the outlook for both these subsegments in FY21 and even beyond in terms of both top line as well as margins?
So thank you for the question. Yes, we do see clearly the opportunity for us to continue this growth. As we said, we are seeing the green shoots in performance after all the corrections that we did in Africa, and we expect this to be sustained. The fact of the softness in the market is a reality because many of the markets were closed. The general practitioners were not available. The pharmacies were closed. And obviously, there was that softness that we had seen. Some of the countries have started relaxing the lockdowns and have started opening up. But as far as our business is concerned, we continue to be optimistic, and we think that the growth will continue from here on. As far as our institutional business is concerned, yes, we took a decision to stay away and not participate in certain products which would have brought the gross margin at the overall company level down and would have impacted it adversely. So we chose to stay with products where we get a benefit of improved gross margin. That is playing out in reality. And with the TLD approval and the approvals that we expect to get from individual countries, we also, with the launch of TLD in H2, we think that will clearly add another fillip to the growth that we are seeing.
And in terms of margins, so will we see operating leverage coming into play, especially on the institutional business?
Yes, because we've chosen to stay away from products that were lower in gross margin, and we chose to have the right product mix where the gross margin improvement did happen. That has clearly resulted in an overall benefit to the organization.
Understood. Secondly, sir, on the decision to put on hold investments in sterile injectables, now Arun sir did mention about the two main reasons, ranitidine as well as COVID-19. But just wanted to understand what have been the investments done in this entity till now, till date, and if you could just split that between strides as well as the promoters, that would be helpful.
So we can't give you those specifics at this time. It's just that there are several pipeline deals that are in the works. We are trying to delay as many of them for strides to be participating in that. But at this time, it's very nascent. It's a question of how much capital you need to commit. It's not how much that is being invested.
Okay, and fair enough. But any color on what was the planned capital outlay, assuming things had gone as per plan?
It will take any business like in steroids would take between $100 and $125 million till we break even. Of course, we had the ability of leveraging some capacities in Stellas. So therefore, the infrastructure cost will be slightly lower. And in this case, the break-even point would have been an investment of between $60 to $70 million.
Okay, great. Thank you, Arun. That's all from my side. All the best.
Thank you.
Thank you very much. Next question is from Sriram Rathi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So congratulations on the good set of numbers. So first question on the US sales. This quarter we did around $50 million. So sir, I mean our target was around $240 million for the full year. Is it fair to assume that the additional $40 million gap will be largely coming from the new approval?
Yes. As indicated in our commentary earlier as well, we clearly expect the new approval to contribute towards that.
Okay. So basically we have different opportunities which may come during the course of the year.
That's correct.
Okay, got it. Thank you. And so secondly, particularly on the SG&A cost, other expenses, this quarter seems to be on the higher side. I mean, on YOY basis, it is higher by almost 50 crores and QQ around 30 crores. Much higher than the growth in the sales. Any particular reason for the same?
Yeah, so this mainly because of three things. One is we consolidated Pharma business into our group. That added Germany, the business in Germany, we started consolidating from Q1. That was one. Second thing is there has been an increase in freight cost that has been alluded by Dr. commentary. The third is there is also an increase in R&D cost from the last quarter to the current quarter. So all three put together is about 30 crores.
Okay. So basically this is something which we should expect to continue, except maybe the freight cost may come down.
Yes.
Okay, got it. And sir, lastly, on the Stellas side, I mean, by when we are expecting it to consolidate into the numbers?
Q4.
Q4. Okay. And this is
Q4 or Q1 of next year. It depends upon, because like I said, because of this COVID situation, we are not able to get some of the mammalian site is the biggest site in terms of readiness, and that is what requires a lot more capital. So Strides is currently investing need-based. So depending upon, I think it will be more Q4, if not Q1.
Okay, got it. Thank you. And so just with relation to the same, the losses that we are reporting in terms of JV and associates, so what proportion of that would be because of Stellas?
It's about 70%.
How much? Pardon?
70%.
Okay. Thank you so much.
Thank you very much. Next question is from Anmol from JM Financial. Please go ahead.
Yeah, thanks for taking my question. My first question is to Dr. Anand. Dr. Anand, congratulations on a great set of numbers. But I just wanted to understand that you did allude to a lot of COVID-related disruption. My sense is that if you look at the impact of COVID, again, based on your commentary, what we've seen is the worst of the impact should have been felt this quarter, both on the demand side as well as the supply side. So any particular reason for the extreme cautious view that you're outlining in terms of the impact of COVID not being true? Because consistent with other company managements and your performance, you tend to think that you've weathered this rather well. So any thoughts there?
First of all, thank you. So there are two aspects here. One, which I talked about from a market perspective, was clearly to indicate that did play out in Q1, and we still managed to get to the levels that we grew in Q1. As far as the challenges are concerned, it's significantly related to people that I mentioned, because if you see the spurt in COVID cases, which is around us, particularly in Karnataka, there's significant increase that's happening currently. A lot of people every single day are reporting to be COVID positive. And therefore, any of those, if that plays out into our manufacturing and supply chain, is unforeseen and can have an impact. So I was alluding from that perspective.
Okay, thank you. That's helpful. My second question is to Arun. Arun, we've seen after a long time quite a few positive things happen in the business consistently across lines. Institutional direct markets both have started turning around. Free cash flow generation has been robust. People are alluding to some kind of a turn as far as the US cycle is concerned in generics. This is hardly a construct, for moderating investments. So, with our debt equity at 1.7 and the business environment looking up, what's again driving the extremely conservative outlook in terms of investment? You surely have taken bolder calls than that in the previous cycle. So just wanted to know your thoughts on that.
So the good result is because we have a good new management. So that's the first point. As far as I don't think it's conservative at all. What we're basically saying is that the ambiguity around people availability to come to work in facilities is getting, it's a lot more than what one believes. When you sit there in Bombay and when you see things are getting better. In the southern parts of India, we are now seeing what you guys saw 2-3 months ago in Bombay. We are seeing a lot of absenteeism, and this has impacts because our plants run 24/7, right? They're fully occupied. So that's clearly the challenge in terms of, as we see more and more cases, are anticipating challenges in manufacturing and all of that. So we are consistently using the word, we continue to be optimistic, but we are cautiously optimistic because there are things that are not in our control. Further, to reaffirm what Anand said, while there has been a frenzy of stocking and stockpiling, when there is no acute demand, typically demand across, as you probably see in India and the US and in Europe, the IMS data shows drop in prescriptions. So, and also if you look at the number of stores that have been shut down in COVID at Walgreens or CVS, all of that has an impact. We strongly believe that our portfolio and our reach, especially in Europe and other markets, will ensure that there's continuity in the business, and there are but challenges that we want to call out. I mean, I'm not so sure what the other companies say, but this is the reality at which Strides operates. We are not suggesting our order books are not full. We're not suggesting that we do not have the ability to execute. We have a fairly strong inventory levels, so that's not getting impacted. So our inventory refills are getting all right. Maybe our inventory level days have come down a bit, but it is important to be cautiously optimistic at this time, and that's all we are saying. And we delivered a stellar bowled out number, so that reflects like nothing changes from that.
Thank you. That's helpful. I'll have more questions. I'll get back to you.
Thank you.
Thank you very much. Next question is from Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah. Congrats on great set of numbers. Just one question from my end. On the opening remarks, you alluded to making investments for the advanced market on the insulin platform. So, how much that amount would be and over what period of time?
So sorry to interrupt you. May I request you to speak a bit louder and repeat your question, please?
Am I audible?
Yeah, I got the question. Tushar, right?
Yeah. Yes.
Yeah, hi Tushar. So we believe that the new regulatory pathways that the FDA has proposed will reduce the development cost by about $50 million per analog to a typical European study cost, which will be about $25 million. So what would have been $75 to $100 million is now $25 to $30 million. That leaves a bigger opportunity for us to develop the product to a later stage licensing if we want to, so that we get better economics, or to take it to market given all the noise about insulin and the need for being more competitive. So this is an optionality that we have. Had the regulatory changes not been done, we probably would have gone and licensed this product out much earlier than what we are proposing to do now.
Okay, sir. That helps. Thanks.
Thank you very much. Next question is from Kunal Randeria from Antique Stock Broking. Please go ahead.
Yeah, hi. Good evening, everyone. So you actually had started export of favipiravir in April. Did it have a meaningful contribution in the quarter?
So we had some contribution from favipiravir, certainly, but nothing material.
Okay. Fair enough. But I mean, under which line item would it be booked?
It would be under the institutional.
Okay. So my second question is regarding those 18 ANDAs that you had published, that you had purchased in February. So I was just wondering if you can provide some more details around it. I believe you also have secured marketing rights of levothyroxine. Just wondering where we are in terms of, the filing status and what are the plans to commercialize those ANDAs?
So let me split response in terms of two types, different types of products. There have been one set of products where after acquisition we have had to do site transfers as well as to do change in the source of API, which we've done, and many of those products are either under stability studies or have been filed with the FDA with those source changes and site changes because that needed to make those products viable. So we've done that. Some of the products we are awaiting FDA approval. And on levothyroxine specifically, I'm happy to say that we just filed the one ANDA during this month.
Okay. And have you sort of booked any, expect any revenues in this fiscal? Approval and revenues this year?
No, not in this fiscal.
Not in this. Okay, fair enough.
Given that they have either been passed or filing of a new ANDA in the case of levothyroxine.
Okay, and the other three R&Ds, when do you expect to file?
Sorry, which ones? On the levothyroxine? By the end of quarter 3.
Okay, sure. And just one more question, if you can squeeze in. Can you just remind us on the status of those 2 CGT products that you had?
At this point, a bit difficult because it's under regulatory status, so very difficult for us to give a update on that.
One of them, we lost the CGT status, but we launched it just after the other company, and we have a bigger market share than the original seller.
Okay. Sorry. Yeah. So, one of it, when you said two CGTs, one of the CGT products, as Arun said, it's right. We lost the CGT status, and so we launched it on day 181 after our competitor launched. On the other one, it's still under FDA regulatory process.
Okay. Thank you.
Thank you very much. Next question is from Karthik Mehta from Clay Capital. Please go ahead.
Yeah, hi. I have a question on the new vaccine business. It is interesting that you speak about 25 million lyophilized vaccines also. Hello, am I audible? Hello?
Karthik, go ahead.
Yeah. So, from commissioning to commercial manufacturing, can you help us in terms of timelines or in terms of regulatory approval or in terms of any other thing which is required to manufacture from now till December 2020? How should we look at this business?
Well, if you read the document, Karthik, it says that we started construction of a vaccine line by carving out a part of the facility. It required dedicated capabilities, which we have. And by December, we'll commission the facility. We are doing this in under 5 months.
Yeah. So, is there test batches, etc., which you have run, or and when you say
we are not doing any vaccines ourselves. We are offering manufacturing services for companies who are looking for capacities in vaccines. So once the facility is ready in December, we will only start taking validation batches of potential vaccines that we think we would have signed up by then, and not before then. So it's just an incremental capacity given the acute shortage of vaccine capacity for a particular type of vaccines that we have called out in our release.
Sure. So is it fair to assume, Arun, that in FY21 you could see some amount of revenue for 2 months or so?
That is the idea of having ramped up start to validation in 5 months. That's the idea.
And the nature of companies, are we talking about exporting it? Because you mentioned lyophilized vaccine, so one name obviously comes to our mind. So is it only exporting, or is it a mix of everything else?
Well, we will offer the capacity, obviously, depending upon who wants it most. And if we can deliver to India, if there's capacity is required, then we'll obviously offer it to India first. But at this time, the idea is to partner with companies who are having challenges on capacity, and if that is the case, then it will be an export business, obviously.
And the second one is on the insulin part of the business, which is there in the biopharma vertical. What is the timeline that one should run with for you to come, assuming that phase 1 will actually start in Q1FY21, and on the backdrop that insulin prices are coming down, can you have an accelerated trial or an approval in those? Anything on those lines?
No, we don't think so. We don't think we'll have revenues in insulin for at least 30 months from now.
Sorry, how many months you said?
30.
Thank you, and all the best.
Thank you.
Thank you very much. Next question is from Saurabh Shah from AUM Fund Advisors. Please go ahead.
Hi, Arun. So the question about Stellas, you mentioned that this could become big, should break even in FY22. Just want to get a sense of order of magnitude. What kind of revenues would this imply? And, maybe over the next year after that, what kind of headline number we should look at in terms of revenues from Stellas?
So I don't think we can give any specific revenue numbers. Typically in the biosim CDMO business, gross margins run at 75% plus, which is very standard industry, as a CDMO or a services. And we need to have an OpEx recovery of only $20 million given this operation for us, not including the R&D spend that we will do for the programs that we plan to market ourselves. But from an entire OpEx, that's what it takes, and we think we will get there in the next financial year.
And going forward, you think that could scale up dramatically, because given the capex going plus 25, you expect to spend additionally this year as well. Just trying to see when the return on this and what kind of order.
It takes only about 10 to 12% of capacity utilization to break even, and this is not unique to us. This is very typical of the industry and how it operates. It's just that the gestation is significantly longer, and I think we are almost done with the high capex gestation phase, and it's about time that we now get into an operational break-even, and then once we see revenues on our portfolio and the CDMO business is coming, I think this will be a smooth sail. It is, and that is where I'm spending a lot of time myself to ensure that we get all the right people and the right outcomes, and I'm quite confident that we are on the right track here.
Any change in perspective given what we hear about the changes in healthcare reform, healthcare regulation in the US, more sourcing inside the country, lowering costs? Any impact on that on the whole Stellas operation?
I don't think that any business can be based on what's happening in the US. I know we all get a lot fascinated with what happens there, but the whole world, there is currently 300 million people unmet for insulin. The whole world is your market. And we now have an arbitrage, a better arbitrage in the US given the fact that the regulatory pathways have improved. We expect if we have a great phase 1 study, we can get a phase 3 waiver. So that's really made the business a lot more interesting from the total capital deployed on each of the analogs to what market opportunities you can have. And if in Trump's directive a couple of weeks ago, the first point is insulin, it's because it's still high price. There's a lot of patients who don't get insulin, but it's just that there is insulin challenges everywhere, which is unmet. And as long as we can make affordable insulin, which we can, given our platform technology, I just think that we will be able to attract a lot more customer and patient pool. It doesn't matter which market it is. So we're creating a program to meet global standards, but we will be very happy to sell to emerging markets or partner in the US with other companies. So it's early days. We'll keep you posted as this business is getting traction.
Okay. Thanks. The next question was just on the overall capex. I don't know if Dr. Anand, you want to cover that. Except for the 25 million on Stellas and on injectables, if any decided later, what else is the capex you're assuming for the next 2 years, that is until FY22?
So in Q1, we spent about 300 million rupees. So we expect to maintain in a similar range.
Okay, so nothing more, nothing major other than this. Okay, that's it from my side. Thank you.
But last few years, we have spent a significant money in hard capex, and in the last call also we highlighted that most of our capex programs in terms of hard capex, excepting the West Palm Beach, has been complete.
Great.
Thank you very much. Next participant is Nitin Agarwal from IDFC Securities. Please go ahead.
Hi, thanks for taking my question. Dr. Anand, on the Palm Beach facility, where is the status on the facility in terms of revenue contribution from that facility?
So the West Palm Beach facility has started some initial revenues coming in, but it will start truly flowing in only in H2, more towards Q4. We've completed the tech transfer of products to that site. Those products have, at least the first product is loaded on stability. Other two products, as we speak, during the course of this month, are getting loaded into stability. We will have CD30 submission to the FDA, and post that, those products will be out in the market.
So how many products are we talking about tech transferring to that facility, and what does that do? I mean, what does this tech transfer do for us in terms of our capacity or our ability to take market share in these products?
So the advantage of the West Palm Beach facility that we have, and the reason we are transferring some of these, apart from being in market for the US, also offers us the ability to participate in the VA program. I think that's the key dimension out there. Now, in terms of number of products, we've got series of our soft gelatin capsules lined. So the products that we have currently in our portfolio, we also plan to qualify that in West Palm Beach, as I said, because then we can start participating in the DoD and the FSS program as a part of the VA supply.
And for this portfolio, is the VA supply a major, is a meaningful opportunity for us in an incremental basis?
Again, I won't say whether it's major or not, but it is, VA supplies are a significant part of the overall market, and so we would certainly like to participate in that.
Okay. And secondly, on the US business for the year, I mean, how many, for the balance part of the year, how many new launches are we anticipating in the market?
So we would anticipate probably between 4 and 5 product launches as we keep looking at the scenario out in the market, plus some of the new product approvals that we get.
And that should be enough for you to sort of bridge that $40-50 million gap which is there to meet a full year number?
I think it's a combination, right? We launched already products in the last quarter. Now that will get the full year realization of the revenues, plus the new products that we will launch. It's a combination of the two.
But Nitin, if I may add, this is Arun, don't discount the other regulated markets. What we're basically saying is that if for whatever reasons the US business is not tracking, COVID or other reasons not in our control, but otherwise we are well on track to get to the guidance. Between the two businesses, we will definitely deliver a very strong outcome irrespective of COVID or whatever for that matter. Given the significant growth, as you probably realize that the other regulated markets are growing at a faster clip than the US. But notwithstanding that, we still continue to believe that the US would be the market which pivots the company to get back to a very significant growth and also margins.
Arun, linked to that, I mean, on the and if you guys can answer that, on the other developed markets, with the market developments that have happened over the last 3 to 4 months, 3 or 4, 5 months with the COVID situation, how has the market environment sort of changed? Has it become more favorable for our strategy, or I mean, how is that playing out for us now?
So how I see it is that as far as acute prescriptions globally, we see a drop globally, and that's not unique for Strides. IMS says that, simply says that. You can do your check. But what happens is that with the velocity of filings that we did in the last 2 years in the other rates, which didn't get any limelight because everybody is so focused on what's happening in the US, we are able to improve our basket of offerings, which is leading to this growth. So from the other rates, we are not so much worried compared to the US, because the US is dependent on at least $40-odd million of new product launches, like we articulated last. And we are confident that those launches will happen. And we continue to gain that, having dropped $25 million of revenues or $20-odd million of revenues in Q4. We continue to believe that market shares on our existing products and new launches will gather momentum. And if that happens, then of course the 220, 240 is a breeze. But if for whatever reason it won't happen, and those reasons are not only because of things that are not in our control, then all I'm saying is that we have a mirrored market in the other rates, which is growing faster at the same margin profile. And that is why the gross margins continue to remain robust in the company.
Okay. Thanks and best of luck.
Thank you very much. Next question is from Sachin Kasera from Swan Investment Managers. Please go ahead.
Congrats, sir, for a good set of numbers. Can you just update us on the current status of the Singapore facility? How is it ramping up? Is it now working at full capacity, or there's still some spare capacity there?
So the Singapore facility continues to operate well, though it's not to the full capacity. but it's operating at a fairly decent level of capacity utilization. Again, that's a site which is an extremely important site for us to support the VA program, given that it's a TAA designated country, and therefore we continue to keep transferring tech transferring products there as well as a part of dual site registration, so that we continue to support from our flagship site for the regular retail market, while the Singapore site continues to support for the VA program. But yes, we still have capacity available there, and that will be used as we keep getting new product approvals, and that needs to support the VA program. We'll use it.
So my second question is regarding the balance sheet. So this quarter we have seen significant cash generation and margins, because of which the net debt has come down and the return on capital has improved. So how do you see this both these two numbers maybe by the end of the year?
See, the last quarter we had very robust cash flows generation. We generated about 200 crores in terms of the operating cash flows, and the net cash flow generation has been about 75 crores. The post investment in the biotech business of about 50 crores. So we expect to maintain a decent trend, and we believe that we'll have to wait and watch as it goes along, and we'll get a much better picture in Q2.
Okay, thanks.
Thank you very much. Ladies and gentlemen, due to time constraint, we'll take last two questions. Next question is from Ravi Sundaram from Sundaram Family Investments. Please go ahead.
Thank you. Thank you for the opportunity. I have two questions. My first question is on the TLD approval that you've got. I think I asked this in the previous quarter con call also. My question is, what kind of opportunity size are we looking at here? I understand the business is evolving from TLE to TLD, especially on institutional ARV business. So, what kind of opportunity does the management look at here for H2 and for the upcoming year?
Yeah. So as I indicated, since our receipt of the WHO PQ approval, we have now filed to individual countries for the NMRA process and the WHO collaborative process to get approvals, country-specific approvals. This is not a PEPFAR approval, so I just want to sort of be very clear that this will not be participating in the PEPFAR approval-related procurement. But we expect that during the H2, all these country-specific approvals will come in place, and we will be able to participate in those donor-funded programs where supplies to those countries are required.
Okay. And a second question on the pledge side. Now that a group company is Stellas through, do we have a ballpark number on which quarter likely the pledge is likely to be reduced?
When the deal is completed, we haven't got our monies as yet. So we'll let you know in the next call.
Okay. Thank you, sir. All the very best. Yep.
Thank you.
Thank you very much. Next question is from Pritesh Vora from Mission Holdings Private Limited. Please go ahead.
Congratulations, very good sets of numbers. I have this question. While we are in many businesses like emerging, non-emerging, the regulated market, non-regulated market, as well as the biotech, vaccine. So it is one way you are targeting a long-term growth for the company, but other way, if you look at it, where are we focused on which business as of now, which will result into a good revenue as well as EBITDA over the next 2-3 years?
Yeah, I strongly recommend you connect with Abhishek so that he can take you through the story of Strides. And probably have not spent time to understand the company enough. We are very focused on what we do, and we are very focused on the investments that we deploy, which creates significant value over time. But this is not the forum and the time to have this conversation, but please do not hesitate to call us, and we'll be more than happy to spend as long as time as you want for you to have a different view on your thinking on why a diverse business plays a very valuable role for stakeholders.
Right. And my next question is the Puducherry facility. you mentioned about the ongoing inspection. So, what sort of revenue comes out of this facility, and what will be the impact of this facility when it comes on stream?
At this time, Puducherry has got no negative impacts. Whatever business we were doing before the FDA issue, we continue to do the same numbers. We do not have an import alert in this plant. We only have a warning letter which allows us to continue to sell products. And all those products are produced in 1 or 2 factories, and therefore there is no revenue impact. The only impact is that some of our approvals are pending. 4 or 5 critical approvals are pending, which once this inspection reclassification is over, will come through and which will start improving the numbers from that facility. But at this time, the Puducherry plant runs fully booked, is very busy, and is doing things under heightened supervision. So there's no negative impact on the numbers.
Okay, and if I can squeeze the last question, we are seeing a lot of companies are reporting a good sets of turnaround in the U.S. market. Arun Kumar, what according to you is the key reasons behind the superlative performance from the U.S. market?
I am not a judge of what other companies do. I think the U.S. market is a function of demand and supply. And I think there's a lot of rational thinking now on pricing. People are, because of increased API pricing, supply chain issues, nobody's chasing market share. Everybody's chasing good quality business. And I think that's a very good behavior for the industry. We have been following that for 8 quarters. If you recall, in our 8-quarter reports, we have said we have had no price erosion on any quarter. And it's all about product selection and how do you engage with your customers and make them happy. I think there's a lot of discipline global industry is brought into all markets, which is good for the industry. And I think that's the reason why everybody is benefiting from it. It's just being more rational and allocating capital and time more efficiently.
All right, sir. Wish you all the best. Thank you.
Thank you very much. I will now hand the conference over to the management for closing remarks.
Hello. Sorry, Abhishek?
So the closing comments, sir. You're done.
Thank you all. Appreciate your time today. And like we always say, it's a pleasure interacting. We are always available. Please get in touch with us, and we will answer any queries that may have been unanswered or for paucity of time. Thank you all, and be safe and have a wonderful evening. Thank you.
Thank you.
Thank you very much. On behalf of Strides Pharma Science Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.